Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As the trade waits for this Friday's quarterly report from the USDA to be released, the markets themselves have been range-bound and have found difficulty in being able to break away in anticipation of the report. We made a significant low on our time factor that we mentioned before, and from here the market has edged its way up a little bit but found a bit of resistance near the 353 number that we've mentioned in the past. The market closed above this level twice but has since been trading below, and currently we find a little bit of support coming in at the 348 number. Right now the market has made a higher low from the previous significant low from August 31st, and so it's going to be key right now to see whether or not the market's able to break away in the advent of this upcoming report. We anticipate a bit of volatility to occur when the report is released, but right now the significant level that we're looking at is whether or not the market closes below 348 or beyond our most recent highs to see if the market's able to get some legs. Some of the congestion right now for December corn exists right inside of volatility-based resistance overhead, and we can also see the 315-degree mark at 354 giving the market some trouble as well. If and when the market's able to break through this area, the next area of resistance that we'd be looking to is about 363.5. And down below, we have potential support coming in at 344.5. We anticipate that the market in all likelihood will break below this number, and we're looking for a minimum price objective that touches somewhere near 335. Moving on to November beans, we find that the 979 to 984 region that we spoke of last week is holding up very well. The market moved up into this area, and we can see very clear resistance having occurred there, with the market having traveled down 3 days from there. Our bias right now is for potential continued weakness, and we want to show you how that has come about. From the July 11th high down to the recent low that we saw on August 16, the market moved 26 bars or 26 trading days or 36 calendar days. From that move forward, we now find the market has done the exact same in the other direction, moving up 26 trading days from that low. What we're also noticing is that the market was only able to recover about 52% of that range over the course of that same amount of time. This produces for us what we call overbalance, where the market is not able to recapture the move that it made in one direction back in the other direction. Since in the same amount of time, the market was only able to recover about 50% of the movement down, we believe that the market is predisposed to continued weakness, and we're looking for the market to again test somewhere in the neighborhood of 900 and possibly as low as 880. So given where we are right now with the upcoming USDA report on Friday, we anticipate a bit of volatility, but in the long haul, we're looking for the market to continue down going into October. From this vantage point, we can also see that resistance came in right up against our 180-degree mark, and so we can again see that the 983 to 984 level was very good resistance for this contract. Downside, as we mentioned before, our potential target rests somewhere in the neighborhood of 890, and the potential support that we can see initially in the event that the market does test this level is near 921.50. Between now and Friday, we anticipate that 950 looks to be good support for this market, and once the USDA report is released, we anticipate that the market will find its way on either side of this key support level for this week. After reaching our price objective of 424, December week continues to rise, surprisingly so. At this point, we have some overhead resistance that we would like to identify as potential terminal zones for this recent advance that we've been seeing. The first one sits at 468.25, followed by 482.25, and then lastly at 496.5. One of these three levels we anticipate are going to be significant resistance as this market has been making its way up. The first level of interest that we'll be looking toward is the 468.25 number as we approach Friday's USDA report. Our cycle work indicates that wheat should be running down, but it could very well be that the decline has now been caked into the price and the markets are simply edging its way higher and higher. The next significant time factor that we have on the horizon sits near the October 22nd timeline. And so we anticipate that regardless of how the market moves between now and then, whether the market moves up or down into this late October timeline, that we anticipate a potential reversal coming in near that threshold. One standard deviation below the point of control of 482.5 sits at 445. And as we can see here, that 445 number ended up being very good resistance over the past couple days. As market looks to potentially make its way up, in conjunction with that 482 number that we talked about, which is that 50% retracement of this key range, we have the point of control sitting at that level. So in the event that we see some volatility through this 468 number, we think that the 468.5 looks to be the area where this market can really find a true terminal space before turning back down. When looking at our volatility-based support and resistance bands, we can see that the market now has just crossed the key level above the 460 3/4 number. And above this number, we anticipate that there's a very good shot that we can test the 469 to 473 area. In addition to that, we also have our volatility band setting up, and we can see that 483, consistent with the levels that we saw before, are very close to the current band that we're seeing shaping up. And so we like that 483 number as the potential terminal area for this move before we can see the next leg down. December crude oil futures continues to move very well. After having finally broken through our $51 mark that we had been speaking of, the market breaks through very nicely, and our next target zone of 52.80 is very close at hand. The market got very close to it and is consolidated a bit, but we continue to anticipate that we should reach that 52.80 mark in the not too distant future. Upon being able to break through this area, we're looking at the next potential target objective about 54.75. But depending on the way in which this market responds to this 52.80 mark, it is possible that the market could terminate here and then begin to turn back down again. It's been a very nice ride after having seen very key support near the 47 number that we spoke about several weeks ago. And as the market has made its way up, finally breaking through that 51, it's very nice to see the way in which the market has responded to some of our key levels. The key threshold that we would be looking at going forward would be the $50 mark. And in the event that the market closes below 50 prior to closing above 52.80, we anticipate that the move could very well be terminated here in this area, and we then would be looking for the market to retest previous lows coming back down to about 43. Moving on to December cotton, we can see that the market continues to be range bound, with the overhead resistance sitting at about 69.73 and downside support coming in somewhere near 68. As the market continues to churn inside of this area, we continue to like the September 29 date as a potential time factor where the market could very well break out of this sideways movement and continue lower with some strength, at which point we'd be looking at a potential target somewhere in the neighborhood of 66.40. But again, the market has been consolidating inside of its recent move the last 2 to 3 weeks, and from here we simply would wait for a very clean trade to materialize before recommending either direction for its movement. In trying to determine a key breakout level for the cotton contract, we applied one of our techniques where we took a measure of the significant low followed by the significant high, took a measure at the pitch at which this movement happened, and then took fractals of this level. In doing so, we now find the market is trading inside of what we can consider a small channel or tunnel of sorts. And you can see how the market responded very well coming into the bottom of that tunnel or the bottom of that channel. Overhead, the top side of the channel has been good resistance with support below. Once this market's able to break through either side of this channel that we're looking at, we believe that we could very well see some very good follow through. So in the event that the market comes in on the 29th in the next couple days, breaks through and gives us a close below this particular bottom end of the channel, we think a good move to the downside could very well start. In closing, we'll take a look at the US dollar, and we're very much liking the way it's moving. We spoke a couple weeks ago about the significance of coming down and touching and reversing at the 90-degree mark of $91. Once the market did this, we suggested that a low of significance could very well be in place, and you can see the way in which it consolidated up against volatility-based support. In doing so, the market has then continued to rise, and the next key level that we spoke about the market reaching was potentially near 93.45. The market has then come up into this area, eclipsed it, and we're looking very close to potentially closing in this area today. We also have overhead volatility-based resistance setting up at our 180-degree mark near 93.88. And so we think we may find a bit of resistance considering the number of days the market has been running up from here. Unlike regular commodities, the currencies can often extend in their trends a little bit longer than your average commodity would, so we do want to watch out for that as well. Some of our key objective levels then that we're looking for is that in the event that the market's able to close above the 93.90 mark, we do believe that reaching somewhere to the neighborhood of 95 is very realistic. So as we continue to monitor the US dollar, we can see that we're now sitting at a potential critical zone where a corrective move to the upside could very well be in play. We also took some liberties to look at a longer-term chart on the US dollar as well. And from here, we can see the significance of the Elliott wave sequence that had been in place. The dollar had been strong for much of the year last year and the prior year. We saw a consolidative move where we made a wave 3 high, coming into a wave 4 low in the middle of 2016. The market topped at the end of the year, giving us a wave 5 terminating spot. Since then, all year long, we've seen that the dollar has been down, and much like it was up for half of the year last year, it's been down for just about 3/4 of the year this year so far. What we would then be looking for at this point is a potential correction that comes up and potentially looks to test volatility-based resistance overhead where we have our potential wave 2 or wave B, and then from here the market to come back down and potentially have a target somewhere in the neighborhood of 87 and change. Most recently, the low that we've seen did eclipse a previous wave 4 low, telling us that the downtrend is still in play, and so at this point we're simply looking for a corrective move or corrective bounce on the longer term chart for the US dollar, and from there for the market to continue lower. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.